Now, when we talk about consolidation, we consolidate the accounts on the face of the financial statement. So we consolidate using the balance sheet, or we consolidate using the statement of comprehensive income, or your what you know to be your income statement, or your profit and loss account. So we consolidate using these two main financial statements. Are you getting it?
Yes.
And by virtue of that, a single balance sheet deals with two separate financial statements. That is either from the parent or from the subsidiary. So you are now going to use one balance sheet to bring together the balance sheet of the parent itself and then the balance sheet of the subsidiary itself. And that balance sheet is now called the group balance sheet. I told you that in a group, we have the mother or the parent and the subsidiary. So at the end of the day, when you are bringing the subsidiary's balance sheet and the parent's balance sheet, therefore, you can now call it the group balance sheet. I get your name?
Yeah.
Good. And so therefore, when you are consolidating the account, there are certain things you must take note of. You need to take note of the stated capital of the subsidiary. You need to take note of the surplus of both the subsidiary and then that of the holding company. And also take note of any other intra-group balances and goodwill that may arise as a result of the consolidation. So we'll be looking at all those things in a nutshell, then you understand. From there, we look at principles of consolidating the balance sheet. When we talk about principles of consolidating the balance sheet, what are the steps or what are the procedures or what are the guiding techniques or what are the guiding principles? What is going to guide you when you are consolidating the balance sheet? And that is what we call principles of consolidating the balance sheet. I get you. Don't worry yourself about the theory here too much. We start the calculation. I'll say all these things in theory. Then once you are practicing, you'll be okay with them. Now, when we are talking about a parent company, number one, can we say that for you to be called a parent company, you should be able to have more than 50% of the voting right. Is that right?
Yes.
Good.
Yes.
Now, for you to call a company a parent company, then this company should take or should have more than 50% of the voting right. In an attempt to do that, there are instances where a parent might have more or all 100%. And when a parent is buying 100% of the voting right of the subsidiary, then that parent has wholly owned the subsidiary. You have wholly, WHOLY. So that subsidiary is now called a wholly owned subsidiary. I get your name? So the parents have everything belongs to the parent. So the subsidiary becomes a wholly owned subsidiary. Number two, You can have a situation where the parents own more than 50%, but less than 100%. Are you getting it?
Yeah.
So let's say
Yeah.
they own 60%, 70, 85, 99, 98, 97. Then in this case, the subsidiary is not a wholly owned subsidiary because the parent did not own everything. Are you getting it? In this case, this is what's called
Yes.
a partially owned subsidiary. And in this scenario, you have the parent, you have the subsidiary, you have the minority. Those who own the
Yeah.
minority side. Yeah. But in the first
Yeah.
scenario, you only have the parent and the subsidiary. You get it? But in the second scenario,
Yes.
you have the parent, the subsidiary, and the minority.
And
Good. So we are going to look at the very first scenario where we have the parent and then we have the subsidiary, which is called the wholly owned subsidiary. Now, we will take the very first illustration. This is a typical illustration. Example 1. So I've sent it to you.
okay.
I've sent it to you. I've sent the questions, the illustrations to you so you can check it later on. Then you can read what you see on the screen.
I can check. Can I check it now or
Oh,
after?
oh, you can check it now. You can check it
Uh,
now. Yes. Because
no,
I
I
leave.
think I can see your screen.
If
Is
you
it the
can,
screen?
yeah, the screen. If you can see, you can read for me. Let me see whether you are seeing.
Example 1. On
Mm-hmm.
31st December 2012, H Limited acquired 100% of the stated capital of S Limited for 25,000. The balance sheet of the two companies at that date was as follows. Tangible fixed assets, 60,000 for H, okay, H
Mm-hmm.
Limited, right?
Yeah.
And then 20,000 for X Limited.
Mm-hmm.
And then investment is 25,000 and nothing for S Limited.
Mm-hmm.
So their total, which is the net current asset.
You have net current as a 15 and 5. Are you getting it?
Yes,
Then you have the finance by section, the stated capital, and then that of the income surplus.
yes,
But the
yes.
question is asking you to prepare the consolidated
Please
balance sheet
prepare the consolidated balance sheet for the group
for the
at
group
31st December 2010.
2013.
Yeah,
Good.
yeah.
Now, how then do we prepare the consolidated balance sheet for the group? The very first thing you must ask yourself is that who is buying who? In the statement that we read, acquisition means you're buying. So they said each
Yeah,
acquired 100% of the stated
100.
capital of S. So it is telling
So
us
it's
that
wholly owned. It's wholly owned
is
subsidiary.
wholly owned. That is where I was even coming to. So if you now you're able to determine it, then that is it. So you must always know the percentage the buyer is buying,
Yeah,
which will form the guiding principle for you to consolidate. Now,
yeah,
if there is no control, you cannot consolidate markets. If there is no control, you cannot consolidate. And so therefore, if H is unable to acquire more than 50%, we cannot consolidate this account. You get it?
Okay.
Good.
Yes.
So once H, we are in the position to know that H has acquired more than 50%, then H is controlling S straight away. You get
eh,
it?
Yes. Yes.
Now, we are being told that H acquired 100%, meaning that H, everything you see on S account from this 20,000
It's for age.
to this 15,000, H has buy everything.
I
H has acquired
yes.
everything. And take note, when they say somebody is acquiring a company or they are buying your company, the person is coming to buy your assets and liability.
Mm.
The person is coming to buy what? The assets and
Asset and liability.
liability. But the person will pay you for the equity and capital. The person will pay you for the equity or the capital
Yes.
and surplus. Now, let me put this scenario so that you understand why the person is not paying for the asset and liability, but he's rather paying for the equity and capital. Are you getting it? Now,
Yes.
we are saying that from accounting equation, asset equals to capital.
It's
Then we went ahead and we said that, okay, when you happen to borrow, I don't want to go into those nitty-gritties plenty. But in an attempt where your capital is not sufficient, you went to borrow to start the
already
business and you are having liability. And so therefore, asset is equal
liability.
to capital plus liability. Are you getting it? Then we turn the account
Yes.
again. Then we say, okay, if we use the business and then we have current asset, blah, 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 you take off the liability from asset, it should be equal to the capital, and so on and so forth. Now, sorry. Now that we know that at the end of the day, assets should be equal to something, should be equal to capital. And that is why you
Capital.
always have the balance sheet one side to be equal to what? The other side.
The other.
Are you
Mm.
getting it? And so therefore,
Yeah.
if I have on this balance sheet here that the stated capital of H is 50,000, the income surplus of of H is 50,000, and so therefore H equity is 100,000. Without seeing the other side of the balance sheet, I can close my eyes and tell you that the net assets of H is equal to 100,000. Are you getting it?
Mm.
If you just bring me the
Yes.
two figures, 50,000, 50,000, and tell me this is the finance by section of H, I can close my eye and tell you that whatever is on the balance sheet of H that you refuse to show to me, I already know. Are you getting it? That when you take off his liability from the asset, his net asset is 100,000, and you open your mouth, I got to know. But that is the trick. And so therefore, when you went ahead and you were doing incomplete records, you said that to know your opening capital, you add your fixed assets, current assets, and then less your current liability, you get opening capital. You did all those illustrations. Are you getting it? Why are you doing that?
Yes.
Because of the principle asset is equal to capital. So when one side has not been
Capital.
given and one side has been given, you can manipulate the account to get it.
Yes.
It is the same thing applies to this one. Now we are coming to buy the company. How then do we know the value of the business
The content.
of the company? And to know the value of the business, we must know the net assets. You know, so the net asset.
Yes.
And
Maybe so.
the net asset is the fixed assets
Casualty.
plus current assets minus current liability. or the fixed assets plus the net current asset. When we say net current asset, it means the current asset minus the current liability. And so therefore, the
Yes.
net current asset, you are seeing 15,000 of each on the account, means that current liability has already been subtracted
Has been
from an
deducted.
amount, and we got 15,000.
Yes.
The same thing of
Yes.
S 5,000 means that the current asset wasn't 5,000. It was more than 5,000, and then they subtracted the current liability from it, and then they got a
Liability.
5,000. Do you get it?
Yes.
Good.
Yes.
So now, if H is coming to buy S, and we wanted to know the net asset of S, in accounting, we said capital plus surplus should be equal to what? Net asset. So now, for us to know the value of S, so that we will now tell H that, okay, this is how much my business worth. So come and pay me this. We must look out for the capital of S, those I marked in red, and the
Yes.
income surplus of S. So when we add these two, we will get 25,000. Is that right? So now
Yes.
we now know that all things being equal, the value of this business is 25,000. Do you get it? So now we can now stand and tell H that H, the business costs 25,000. So it's either H pays at 25,000 or he don't buy the business. Are you getting it? So you know that if you go and quote 30,000 to H, you'll be making a profit of 5,000. Do you
The
get it?
network
Hello?
has started messing.
Can you hear me? Hello?
Can you
Yes, I can hear you. Let's go on.
see me?
Can you hear me? Move on. So as I was saying, the net assets plus the fixed asset give us the value of the business. And so therefore, at the end of the day, for us to know the value of this business, we add the stated capital and then the income surplus. So if we have told H to pay 30,000, then we know H, we are making profit of how much? 5,000 because the value is 25. But when
Yes.
you go and tell H to pay 22, then you are running at a loss of how much?
Lost
3,000. That
3,000.
is what we mean over here. Now,
3,000.
yes, in an attempt to consolidate this account or to buy this company, whatever H will be using to buy this company is called the investment. So the money H will be using to buy the company is called the investment, because whatever H is doing is an investment is doing. So H
Investment. Yes.
money he used to buy S company is called the investment. So H, you will tell H that your company costs 25,000. So H will now mop up 25,000 and come and give to you. Then he will take your assets and then your liabilities over. Are you getting me? So
Yes.
at the end of the day, the investment on each account is used to take care of the capital and surplus of S account, which means that in an attempt to add these two balance sheets together, the investments will no more be there. The stated capital of S and then the surplus of S is not going to be there again. Are you getting the scenario? So let's
Yes.
look at the solution. Now, the solution of this particular illustration, I want to look at the solution of this particular illustration so that you can get it. Now, we are going to consolidate the account. In an attempt to consolidate the account, we add the two balance sheets. Can you see?
Yes.
Good. So we say consolidated balance sheet. Then the asset of H, 60,000, is added to the asset of S, 60,000. We get 80,000. Then we say net current asset. Net current asset. So the net current asset of H, 15,000. And then that of S, 15,000 is added together. 5,000
Can I
is added.
copy?
Oh, you can copy. So
You go on, I'm listening.
60,000 here plus 20,000 here is 80,000. 15 plus 5 here is 20,000. Then you add the two, you get 100,000. Then you go to your finance by, you have stated capital, that of only H. You bring only that of the H because the stated capital of S Limited has been knocked off by the investment of H. And then the surplus will be that of only H because the surplus of S2 has been knocked off by the investment of H. So at the end of the day, you balance of this account. And this is how your consolidated balance sheet for illustration 1 is going to look like.
So it means that when you get the question like that, you only add both and then take out the investments.
And that of the capital and surplus of the subsidiary. But we are going, this is just illustration 1. So it's like the baby must learn how to sit before you crawl, before you stand, before you walk, before you run.
I know, right?
So this is just the beginning.
Okay. 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 Okay.
All right. So let's look at illustration 2. So so we are looking at illustration 2, which is also the same as illustration 1, but this one we have added something small to it.
Sorry, please, can I ask a question?
Oh, ask a question.
And the one we just did.
Yeah.
The one we just did, send it to my phone.
Okay.
The first one we did.
Yeah. The question is there.
You send it via WhatsApp.
The second one to the question is there. It's on your WhatsApp.
Okay, thank you. Okay, thank you.
So look at the second question. H Limited acquire 100% of the share capital of S on 1st January 2013. The balance sheet of the two companies on 31st December 2013 was as follows. You have the intangible fixed assets, you have the investment, you have the net current assets, you have the stated capital, then you have the income surplus. Now, in dealing with questions like this, the preamble and the footnotes are critical to your understanding of the question. So whatever they say in the preamble and whatever they say in the footnote is very, very important. I get it. Now,
Yes.
look at the footnote. They said prepare consolidated balance sheet as at December 31st, 2013 on the basis that goodwill is treated in accordance with IFRS 3. At 1st January 2013, the balance on S income surplus account was 15,000. So now they have introduced two things here in this new illustration. Now, in accordance with IFRS 3, whenever there is goodwill in the account or there is goodwill on the face of the transactions, there are three things that you do. The first thing you do, based on the policy of the company, is one, either we are maintaining the goodwill. When we say we are maintaining the goodwill, it means that it is going to be shown on the balance sheet. It's going to appear on the balance sheet. Number two, either we write off goodwill from the accounts. And when we write off goodwill from the account, it means that it's not going to appear on the face of the balance sheet. Number three, we test for impairment. And when we say impairment, it means that we want to know whether goodwill has suffered a loss, reputational loss of the company is called impairment. So we wanted to find out if the brand name of the company has suffered a loss. Are you getting it? Maybe there was a scandal in that during that time and something happened. So we wanted to know whether, see now it's not, at first when MTN came, everybody likes MTN. Oh, MTN, everybody. But now it's not everybody that speaks good about MTN. Are you getting it? They say, oh, their data is this, their data is that, it's expensive, it's blah, 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 blah. So the goodwill they were having when they were Ariba is not the same goodwill now when they are MTN.
Yes.
Are you getting it? When they have to test for impairment, they can see that maybe the goodwill initially was 5,000, but now it is 4,500. So the 500 is the loss in the goodwill, which is the impairment. Are you getting it? So you test for impairment, which is the third one. And if goodwill has suffered a loss, you write the loss off in the book. And then the remaining goodwill, which is called the unamortized goodwill, is sent to the balance sheets. Are you getting it?
Can you say that? No, can you say that?
So I'm saying that whenever we test for impairment, the amortized goodwill is write off in the book. And the unamortized goodwill is sent to the balance sheet. Are you getting it? Now, once they've mentioned goodwill, then it is okay if I introduce you to the account that we use to determine goodwill when it comes to consolidation. When you have to determine goodwill, you see that they've mentioned goodwill, but they didn't give us the goodwill in the question. So it means that we have to find the
Yes.
goodwill. To find the goodwill, you use the account called the cost of control account. So the cost of control account is used to determine goodwill. The cost of control account is used to determine goodwill. So the purpose of the cost of control account is to determine goodwill. Are you getting it?
Yes.
Now,
Cost.
whenever you want to prepare the cost of control account, or this account is prepared before acquisition, you must know your investment. And from the question, the amount or the money H is investing in S Limited is 30,000. Are you getting it? He is
Yes.
investing 30,000 in S Limited. So that is the investment over here. Are you getting it? And
Yes.
how much of S Limited is he buying? He is buying 100% of S. So when you come here, you strike 100% on S stated capital. We know that S stated capital is 10,000. So you strike 100% on S stated capital, which will give you 10,000. So whichever percentage is buying, you strike it on the S stated capital. Then you get the answer here. Are you getting it?
Yes. Please,
Then
can I write?
oh, be writing. If I'm showing it or you want to write, be writing. It's for you. So write. Now, in this account, we look for what you call the pre-acquisition surplus. And the pre-acquisition surplus is always given in the preamble of the question here. It will be given here, or it will be given in the footnote. So if they don't give it at the top, they will give it at the down. And here you are
The
at the down
footnote.
over here. So they give you pre-acquisition surplus to be 15,000. So you strike the 100% on the 15,000. Then you get 15,000. So the difference on the account is what we are seeing here as the goodwill. So you can see that when I add this and that, I'll get 25,000. So the value of the business is 25,000. Then you have asked each to pay 30,000. And so therefore, 5,000 becomes your profit, which is the goodwill. Then from there, you prepare the balance sheet. So because we were not told to write off goodwill, we didn't test for any impairment. We maintain the goodwill. So the goodwill of 5,000 that you had over here, are you seeing it? You are now representing it over here. So consolidated balance sheet, goodwill 5,000. Then the other things follow. So tangible fixed asset, you add the two. Net current asset, you add the two. Then you say finance by stated capital. Then you bring that of only H. then surplus, you add that of H 80,000, then S own is 25,000. But take note, 15,000 was used over here already. So the 15,000 of S surplus that was used, you subtracted it from its remaining 10,000. So this 80 and 10 gives you 90. Are you getting the scenario?
Can you hear me?
Yeah, I can hear you.
Hello.
Yes, I can hear you clearly.
I said, can you go over one more time?
So the balance sheet, you mean the balance sheet?
Yes, please.
Okay. So we said you have your goodwill which you didn't write off. You stated there 5,000. Then you add your asset like the way we did for the illustration one, 8525.
Okay.
Then the net
Okay.
current assets to 15 and 10. You add them because I told you consolidation is just a matter of adding. Now,
Then yes.
when you come to the stated capital, the stated capital of S 10,000, everything was acquired here. I getting 100%. He acquired everything. I getting it. He
Yes.
paid for it. But the surplus, he paid for only 15,000. Bear in mind, I getting it. The surplus, he paid for
Yes.
only 15,000. But the surplus on S account is 25,000. Are you getting it?
Okay.
Mhm. So
Yes.
they were telling you that before he come and buy, he was buying the company. There was a surplus of 15,000. Are you getting it?
Mm.
So he bought that
Mm.
15,000. But after the 1 year, the surplus now is 25,000. So inside this 25, there is 15,000 inside, which was there before he came. So when we are
Yes.
adding the surpluses, we must take the 15,000 which was there before he came out of it. So we take that one too out of it, and then we get 90,000. So when we get to next illustration in our subsequent meeting, I will now take my
Yes.
time and explain the surpluses for you very well. Are you getting it?
Okay.
Then you can now get the
Yes.
breakdown of everything. But for now, just understand it in this way. Then we can make a headway. Okay.
Okay.
Yeah. So this morning, these are the two illustrations I want us to do, and
Okay.
you kindly go through very well and make sure you are getting the understanding so that when we are adding more and more to it, you will not be found wanting. Okay. Do you have any question for me?